Good evening, everyone, and this is Terence, and welcome to another round of webinar series, Vertical Spreads Optimization. My name is Terence, and I'll be your host for the day. If you have any questions, please type into the chat box on the right side. I will try my best to answer all your questions. If I miss any of your questions, please send me an email. So my email will be terence@livetrader.com, and today we'll be talking about vertical spreads. And a lot of you who have a lot of I would say challenges when it comes to vertical spreads trading, because we know that to trade a spread we need high probabilities, but a lot of times our spreads are tested. So we face a lot of whipsaws, we face a lot of challenges when the market is going against us. So the question is, how do we minimize vertical spreads risk, and at the same time um, improve the timing of our vertical spreads? Because a lot of time, even if we are right, the market seems to whipsaw and that spread might just go out of money. So the question is, how do we minimize based on support resistances, as well as using the Elliott wave analysis? And today's workshop or webinar, if you like to call it, will be very important, because I will be discussing in detail how we use conditional stops when it comes to vertical spreads trading. Okay, so as I go through this webinar, if you have any questions, please type in the chat box. Right, so got a few questions from the traders. This webinar has been recorded, so I will try my best to upload it to the GoToMeeting server, and if the server is not overloaded, you can just replay this webinar and over again. So if you can hear me, just type in the chat box, just so that my voice is clear, that you can hear me. Okay, very good. Thank you so much for your responses. So let's go into detail for today's webinar. Right, so today's topic will be how do we minimize vertical spread losses, how do we increase the probability of success for vertical spread, as well as I'll be presenting some statistics we have gained for vertical spread trading. And a lot of times, if we were to place a few take profit, conditional take profits on vertical spreads, the statistics on taking profit at about 50%, which I'll show you later in this webinar, will be much higher compared to just letting that vertical spread expire by itself. So what this means is, if a vertical spread goes in the money and it hits 50% of the total profit, in the statistics, we'll show you how taking 50% of the vertical spreads profit will pan out better in the long run. Okay, so I cannot emphasize enough that you have to take your positions, you have to keep your positions small, not taking big risks for every single trades. We do know that there are a lot of very tempting trades coming out, and it seems that a lot of, I would say, some of our traders are taking excessive risks, which is throwing out the risk management. And if you do that, you're putting your portfolio in jeopardy. Okay, so it's very important that you keep all your positions small. Based on the ART the art of trading, I've presented, I believe there was 3 webinars before this webinar. So based on the ART system, you're not supposed to take anything more than 4%. Okay, reason being, if you take excessive risk, number one, if you were to make any trade adjustments, you do not have any more margins. So that's number one. Number two, if you take excessive risk, if the market whipsaws against your position, you might suffer a large loss. So what we need is to keep all our positions small, but at the same time, have a very high probability. So when it comes to vertical spreads, our typical probability for vertical spread ranges from 60 to 70%. So that means that 60 to 70% from now towards the expiry, this trade has a better than 50-50 than a flip of a coin. So typical stock investment, or if you're to trade any other, if you're to buy an option, it'll be less than 50%. So if we take 60 to 70% probability for every single trade and let it span out, say for the next 100 trades, 200 trades, 500 trades, if you guys are still persistent enough to carry on trading for the next 100, 200 trades, see how probability span out in your favor, you'll see that things will stack up by its own. Okay? And also, some of the traders, they are just trading maybe one spread for their entire portfolio, and that is quite risky as well. Even though if you're trading small, but you're just having one spread, a lot of time if that spread goes out of money, you'll be having just one loss, but the other trades are not panning out itself. So an ideal portfolio will have about 2 to 3 vertical spreads, and maybe 2 or 3 are in condos. So like I've laid out earlier, your portfolio is supposed to have security basket and growth basket. So what that means is, for security basket is a very wide type of trading strategy. So your margin of error will be very large. Okay, so you'll be probably trading 2 iron condos or 3 iron condos. For growth basket, you're probably having 3 to 4 vertical spreads. But today we're going to focus more on vertical spreads. Okay. So I received a lot of some emails talking about if my vertical spread is being tested, should we roll it or should we just adjust the cost basis? Okay, so let's go into detail what kind of scenarios we can take if our vertical spreads are being tested. So for beginners in this webinar, I believe there are a few beginner traders. Being tested means that if you have a bullish or bearish vertical spread, the position is going against you. Okay, so let's take a trade that we have recently. So for example, say if we have a trade for BBH, that'll be biotech market index. So assuming we have a bearish bias on BBH, okay, so say if we sell at say 120, okay, and we buy at 121, so that'll be our insurance line. Okay, so the green box will be this area and below. So it means that we want BBH to stay within this green box. Okay, if BBH rises, if the underlying of BBH rises, that means that this vertical spread is being tested. Okay, so what's next? If BBH is being tested from this side, there are a few scenarios you can do. Okay, so Now the most common scenarios would be either roll this spread over. So that means that I roll it to the next month or the following month. Okay, scenario B will be I just take a loss, exit the spread. Okay, now just type in a chat box, which do you think will be a better scenario? Scenario A or B? Just type in the chat box which scenario will be a more practical scenario, or scenario that you think will pan out the best. Okay, thanks for responses. I can see some people say B. Wow, it seems that most of you, all of you in fact, says B. Okay, now the problem with scenario B is if you exit the spread and say if BBH, okay, rises to 1 to 1, 1 to 2, and then suddenly just drop back to the green box, and you just exited that vertical spread. So that is one of the most I would say most common mistake when it comes to uh, beginner traders, because you're not letting this trade pan out by itself. Yeah. Now, a more what I would say fine-tuning your trading strategy will be entering at the right timing. So by entering at the right timing, you're not only increasing your probability of success, you might be increasing your cost basis, the average cost when you establish this vertical spread. So what I mean by entering at right timing, so right now, if we look at BBH, there's not much information telling us that which is the turning point, which is the support, which is the resistance. Okay, so some of the traders, some of you guys are quite familiar with FIB retracements. So a few analyses I'll be doing is I will draw a few retracement, okay, on this move, and I will see what is the next turning point for BBH. Okay, so if I were to just exit in the spread, I could be wrong, because maybe BBH is making an impulsive C wave move or B wave move, or whatever that wave is. Okay, so this trade might move against you for maybe 1 or 2 days. But once you exit this spread, a lot of time traders will see, now the trade is moving in my favor. If I did not close that spread, maybe this would have been in a profit. So this could be one of the mistakes beginner traders make, which I'll go into detail. Right, so let's go step by step. For BBH, okay, a lot of you will exit this spread. Now it's correct to exit a spread when it goes against you, in order to manage those losses and not letting the spread expire worthless, which then you suffer a maximum loss. Okay, so instead of letting this spread expire at its max loss, okay, the question is, where should I place a conditional stop so that this trade is automated, and when BBH reaches a certain point, this trade is taken out. Okay, so let's look at the BBH Elliott wave chart. Just let me just pull in this. Okay, so a very recent example will be S&P 500. This spread has gone against us. Okay, but instead of letting this spread expire at its max profit, where should I place a stop loss? So this all depends on the wave count and also the FIB analysis, which I believe most of traders won't even bother doing homeworks on uh, Elliott wave analysis and so on. Okay, so let's take an example of a good resistance for, say, BBH. Okay, just take October 23rd. Okay, so October the 23rd. Let's look at BBH wave count. It's not here. Yep, there you go. Okay, right. Now let's assume that we have a bearish vertical spread on BBH. I will go through step by step, okay, the flow when we place a trade like this. Okay, so the first step will be I'll be calculating what is the probability for BBH. Okay. So let's say we take about 69-70%. Okay, 67% at a 127 call, 128 call. So we are selling 127 and we are buying 128 as our insurance. Okay, so green box will then be 127 and 128. Okay, now your green box is simple, just drag it to 127. So what this means is it gives you a visualization, it gives you a visual clue of as long as BBH stays in this green box, okay, you are in the profit, and this spread will expire worthless as long as this stays in the green box. Okay, now this is very important. Okay, your FIB retracement studies, again, 38.2, 50%, and 61.8. The next question will be, where is the probable turning point when it comes to FIB retracement? So just type in your answer in the chat box so that I know that you're following. So which is the turning point, the major turning point when it comes to FIB retracement? Is it 50%, is it 38.2, or 61.8? Okay, very good, 61.8. Okay, now the green box, we are selling at 126. Okay, now let's assume we are selling at 125, and so 125 call and 126 as our insurance line. Okay, so now we have a 62% probability of this going in the money. 53 days expiration. Okay, let's run a simulation on BBH. 53 days. So this will be a call, and there'll be 125 negative and 126 as your insurance leg. Okay, click risk profile. So this is how the curve looks like. Okay, now if you note, the loss is way bigger than the gain. Okay, most of the time you do not want to let this expire worthless. Okay, so let's simulate 125, 126. Okay, and that'll be 53 days. Right, the next step, assuming that BBH cannot breach 61.8. If BBH does breach 61.8, the wave count is no longer valid. Okay, say if we contain the losses when BBH reaches 61.8%, okay, how do we place a conditional stop so that this spread is taken out of the markets? Okay, so what we can do is you can place a conditional stop by going to trade monitor, assuming that we have this trade on. So assuming that this is BBH, select two contracts. Okay. Let me just take a trade. Swell on place. Right. Create closing order, assuming this is BBH. Okay. There's a small gear button on the right side. Okay, assuming this BBH at or above in this case. So the underlying will be 125. Okay, you can place slightly higher than 125. So that may be 125.1, if you will. Okay. Create closing order, assuming this is BBH. At or above 125.1. Click save, confirm, and send. Send. Okay, so that is one of the ways to minimize the losses instead of letting this expire worthless like this. Okay. Now, of course, the timing is very important when it comes to trading vertical spread. If you were to ask me to short BBH at this point, chances are we would, because the underlying is not breaching, haven't even breached 50%. So if BBH is at about 123 or 124 zone, I will consider shorting this and establishing a bearish vertical spread, not at this point. Okay, so by using Elliott wave, you can put into context approximately how far that spread, that wave lasts. Okay. Okay, thanks for the comments. I can see a lot of you are following. So that means that 50% will be a next zone we're looking at. If 50% is breached, we're looking at 61.8 turning point. Okay. So when BBH reaches say about 123 or 124, chances are you'll be collecting more premium instead of establishing your bearish vertical spread at this point. So when BBH reaches about 123, 124, and you sell a call at say 125 and buy a call at 126, chances are you're receiving or collecting much more premium compared to this this timing. Okay, so that would be BBH as an example. Now, for rolling a vertical spread, it's not recommended because you're throwing good money after bad money. Okay, so that means that if your spread is making a loss currently, it doesn't make sense for you to roll it over into the next month. You're just compounding your losses. Okay, so a better scenario would be just exiting a trade before its expiry. Okay, so a good way to place a conditional stop is by looking at your Fibonacci retracements and look at the next critical zone. Okay. Now, what about exiting the spread? So a lot of you, I believe all of you, will say that scenario B is a much better scenario compared to A. So if you exit a spread, it all depends on the outlook. Okay, you have to go back and look at where's the current market outlook before even closing out this spread. So if the underlying breaks a certain FIB level, okay, and assuming the outlook is no longer the same, so assuming the initial outlook was bearish, and now assuming just like S&P 500, yes, breached a very critical zone. So the outlook is no longer bearish. Okay, so when the outlook has changed, it is best to just close the spread out or exit that spread. Okay, now the next interesting thing is based on statistics, they found that if you close your vertical spread 50% based on the max profit. So what do I mean by 50% based on max profit? So 50% means that assuming this spread has a max profit of say 30 US dollars or maybe 300 US dollars. Now half of that is probably 15 US dollars. So as long as this spread makes 15 US dollars, okay, I will take this spread, I will take a profit for this spread. Okay, so let's take another example. Say if we take Tesla, okay, and assuming that we are having a bullish bias on Tesla. Okay, so we are going to draw a few FIB study on Tesla. FIB retracement. Okay. So let's assume that Tesla is having a bullish bias. We are having a bullish bias on Tesla, and Tesla is hitting about 78.6%. Okay, and let's just say we establish a spread, a bullish vertical spread for Tesla, and this is our green zone for Tesla. Okay, so let's say we have a spread. We are selling a put at 211 and we are buying a put at 210. So 210 will be our insurance leg, and 211, 212, okay, will be a sell leg. So let's simulate Tesla. Right, so Tesla IV rank, I'll say on the high side. It means that it makes much more sense to sell a spread than to buy a spread. So we'll be selling puts. Okay. I can see a few questions. Don't worry, I'll answer your question shortly. Let me just explain this example for Tesla first. Okay, so assuming that we are opening this position, a bullish vertical position for Tesla. Okay, so we are buying a 200 put and we are selling a 202.5 put for Tesla. So based on this, as long as Tesla stays above 202. So there'll be about this area. Okay, 202. Okay, there we go. So 202, and the insurance leg will be at 200. So that'll be 200. Okay, so as long as Tesla is in this green box, okay, we'll make a profit for the spread. So one way to place a conditional stop, which I've shown you, is you have to create a closing order and then based on the underlying price. Okay, so when Tesla hits, say about at level 200, this spread will be taken out. Else, to place a take profit target of 50% out of this spread, okay, it's easiest to just run a simulated trade on Tesla. So let's say we run a simulated trade for Tesla. Okay,